Hi, and welcome to Random Rogers Big Picture for the week of August 23rd. A couple of things on the agenda this week. First up, something about ETFs, and then something about from The Economist that I think I found through FT Alphaville, but whatever. Something from The Economist about which central bank is going to raise rates first. For those of you who don't know, I'm going up to San Francisco this weekend for something called the Money Show. I'm on two panels on Sunday with about ETFs. One of the panels, unless something has changed, and this is always possible, is going to be moderated by Karen Gibbs. She was on CNBC back in the mid-'90s anyway. I don't know, early 90s maybe late 90s, I don't know. And then she moved over to try and replace the Rukeyser show when they were doing that on PBS for a while. Anyway, that should be kind of interesting. But I went and got my hair cut for this thing. I was overgrown and wanted to time it to just before, so when I went I wouldn't look like an ass. Well, anyway, so first up, let's talk about ETFs. On my Green Faucet post for Friday, I kind of stumbled across what I think is an interesting idea. TickerSpy, I presume every quarter, but however often Harvard has to file, TickerSpy puts up the largest holdings of the Harvard management portfolio, and I imagine they do this for other endowments and other big pools of money as well, and then they maybe have a little bit of commentary. So I went and looked at the 13F, and the vast majority of the in-house portfolio, which by my reckoning is somewhere in the neighborhood of, I don't know, between 5 and 10% anyway, closer to 5% of the whole endowment. And it was something like 1.4 billion of this 1.4 billion, 1.2 of it was in ETFs, and of the 1.4, something like 1.3 was in emerging markets. But so the vast reliance on ETFs got me to thinking about something. Okay, so we all think of the endowments as having, been early and on the forefront of things like private equity and hedge funds, and that grew into, having most of the portfolio in alternative type stuff. Then this caused all sorts of problems for all sorts of endowments, the ones that went down this path. And so now the question is, are they going to revert back to more simpler portfolios, mostly stocks and bonds, and then maybe, something like 5 or 10% in alternative stuff instead of 60 or 70% in alternative stuff. I don't know, but that's a topic of discussion right now. So if that is the case, so let's think about Harvard for a second. 20 billion, is that what they have left? Okay. So let's say they're managing 80% via in-house through stock and bond portfolios. We're making a couple of assumptions here, but that's okay. So we know that they like using ETFs. They're comfortable with that. So let's say, if they've got a $10 billion portfolio in-house, and they want to allocate 4% of the $10 billion to mid-cap or second tier or junior or whatever phrase you want to use, mining companies. International mining, Australia, Canada, I would imagine that would take in Africa, South America, whatever. Okay, 4% or 3%, let's just say 3% of the 10 billion, by my math, that works out to $300 million. So, are they likely to want to go buy all the stocks, or will they just call up iShares and say, build this ETF, we got $300 million for it? Well, kind of interesting. It's much easier for Harvard to do that. And then for iShares, instead of, like these ETF providers, they seem to start most of these funds with 5 million or 10 million in seed money. If they get a call from Harvard with 300 million to buy, seems to me they've got an immediately profitable fund. Maybe not wildly so at 300 million. I'm not sure about that. But it is far from a loss leader with that kind of asset level. Then they issue the fund and they advertise it, as, yeah, this is the fund Harvard wanted us to make for it. So then how many people go along for that ride with Harvard? I would say a fair bit, and I don't know if the fund off of that 300 that we're working with could double to 600, but maybe it could go from 300 to 350 or 400 million. That seems plausible. Point is, it seems like this is kind of a whole new source of ideas. You know, it's the end user literally driving what funds get made. Make this fund for us. There's probably all sorts of reasons why that can't happen, but it's an interesting idea, and I'm going to see if I can run it up any flagpoles anywhere and see if anyone salutes. Okay, next issue is there's an article in The Economist. I will link to it below the video here about whether or not it will be Australia or Norway that raises rates first. Excuse me, at the central bank level. Australia only had 1 quarter of GDP contraction. Norway, I believe, had more than one, but they are roaring back pretty quickly. The krone has been, for the last couple of weeks, gotten a lot, if you watch CNBC Europe, a lot of attention from the currency wonks that come on there as being a favorite destination. So is it going to be one of those two? Okay, if you've been with me for a while, you probably know that I've been huge fans of Australia and Norway for ages. And I want to revisit the ideas about why, because it's very simple for anyone to do this type of thinking. I didn't make these picks based on, what I think is going to happen over the next 3 quarters or whatever like that. In looking at countries, okay, why do you invest any of your portfolio in foreign equities? You do it for diversification. Okay, well, what offers the best type of diversification? Logically, it would have to be a country that has as little in common with the U.S. As possible. If you look at, if we just stick with developed countries for the time being, Norway and Australia clearly, relative to other developed countries, have a whole lot less in common. Certainly less than big Western Europe, France, Germany, Spain, the UK, not part of the EMU obviously, but you get what I'm saying. Those countries have more in common with the U.S. I'm going to say, and maybe this is wrong, this is a subjective opinion, I think those countries are closer to us than Canada. Obviously, we do an enormous amount of trade with Canada, but I think the makeup of the Canadian economy it makes it more different than big Western Europe. So if you're looking for things that are much different and are not big Western Europe, you don't have too many choices. We could probably talk about New Zealand. New Zealand's got a bunch of problems, and it is so small that there is an issue of sufficiency. Not that it wasn't a very attractive investment destination in the middle of this decade, and it will be again, and it's possible that's even already started. But there is a self-sufficiency issue. They have to import an awful lot of stuff to make it work there. But that type of thinking, doesn't require, being particularly smart or sophisticated. God knows I'm not. This is very easily replicated by anybody. And I think by keeping a small little bit, I'm at 3% now. I expect I'll probably go to 5 or 6 with both of them. And then I've got some Norwegian debt and a little less in Australian debt. It makes sense. These markets kind of, they did it before and they kind of did it this time. That they, started rolling over, bottomed, and started coming back at a different timetable than the U.S. market. That is, won't do that every time, but that's a pretty good tell. Now that we've all had it reiterated that markets do move together, it then becomes which one emerges first or which one does it on a different timetable. That way you create some zigzag within your portfolio. All right, that's about it. I'm going to do one thing I never do here, which I am, on Friday, I'm writing a post that I'm going to time bomb publish for Sunday while I'm in San Francisco that I think you're really going to get a kick out of. It's along the lines of retirement stuff, and it's a very unique post, and I think you're going to get a kick out of it. So please check back on Sunday. That's it. Have a good weekend.